The stock market is worth over $60 trillion. Every day, trillions of dollars move through Wall Street in less time than it takes you to eat breakfast. This one market sets the value of Apple, Amazon, Nvidia, Microsoft, and Google. But here is what nobody tells you. It reaches into your retirement account. It touches your job. It shapes your mortgage rate. And when this machine breaks, you feel it, whether you own a single share or not. In 2008, Americans lost more than $10 trillion in stock market wealth. In 2020, the market collapsed 34% in 33 days. In 2022, trillions vanished all over again. Every time, the headlines said the same thing. The market is broken, the market is rigged, the market is over. And every time, something almost nobody expected happened. It recovered, and then it grew bigger than before. Here is the crazy part. Most people who own stocks could not tell you what they actually own. So by the end of this video, you will understand why stocks rise, why crashes happen, and why one boring index fund has quietly created more millionaires than anything else in American history. You are also going to meet Sarah, 25 years old, $500 a month, no special talent for money, and she is going to teach you more about wealth than any trader on Wall Street. Because the stock market is not a casino. It is a machine that prices the future of America. So what is a stock, really? Most people think a stock is a ticker symbol, a flashing number on a screen, a bet. The reality is completely different. A stock is ownership. Buy one share of Apple, and you are not gambling on a symbol. You are buying a tiny sliver of a real company. You own a fraction of its factories, its brands, its cash, and its future profits. Buy a share of Walmart, and you own a piece of every store and every truck in the company. Buy a share of McDonald's, and you own a piece of tens of thousands of restaurants worldwide. Buy a share of Nvidia, and you own a piece of the chips powering the artificial intelligence boom. This is why the stock market exists at all. Companies need money to grow, so they sell tiny pieces of themselves to the public. In exchange, the public shares in whatever those companies earn in the future. That is how Apple went from a small workshop to one of the most valuable businesses on earth, one share at a time. And here is where it gets strange. If a stock is just ownership, why does its price change every second of every trading day? Why did Nvidia climb for years and then drop hard in a single afternoon? Ownership alone does not explain that. To understand it, you need the one force that moves every market on Earth. Stock prices are a bet on future profits. Not today's profits, not last year's profits. The profits investors believe a company will earn years from now. That single idea explains almost everything you are about to learn. Here is the formula hiding behind every stock price on Earth. Stock price equals future earnings, multiplied by investor expectations. Imagine Nvidia earns a certain amount of profit this year. Now imagine investors believe that in 5 years, thanks to artificial intelligence, it will earn 10 times that amount. They are not paying for today's profit. They are paying, right now, for a profit that has not happened yet. This sounds impossible, until you realize it is exactly why a company can lose money for years, the way Amazon did, and still be worth billions. Investors were not buying what Amazon was earning. They were buying what Amazon was going to become. It is the same reason Tesla could be worth more than several traditional automakers combined, long before it sold anywhere near as many cars. This is the heartbeat of the entire market. Stock prices are a bet on future profits. Say that again in your head, because that one sentence explains almost every market headline you will ever read. It explains why a great company can have a falling stock price, if investors expected even more, and why a struggling company can have a rising stock price, if investors expect a turnaround. The market is not grading the past. It is pricing the future, every second, based on millions of guesses happening at once. But that is only half the story. Because what happens when millions of guesses all turn optimistic at exactly the same time? What happens when a price climbs far above anything a company could realistically ever earn? History has an answer, and it is not a gentle one. It is called a bubble. In the late 1990s, investors became convinced that any company with .com in its name would be the next great American business. Prices soared far beyond anything those companies could ever earn. Then, in the year 2000, reality caught up with expectations. Thousands of companies with big ideas and no real profits vanished almost overnight, wiping out fortunes that had only ever existed on paper. In 2008, a crisis built on mortgage debt tore through the banking system, and the S&P 500 lost more than half its value. In 2020, fear of a global pandemic triggered a 34% collapse in 33 days, the fastest crash in modern market history. In 2022, inflation and rising interest rates dragged the market down all over again. And this is where millions of investors make the exact same mistake. When prices fall, the average investor sells because they want the pain to stop. The wealthy investor does something that feels insane. They buy more. Same headlines, same fear. Two completely different outcomes, 30 years later. Because the pattern underneath every crash is not really economics. It is emotion. Fear causes selling. Greed causes buying. Remember, stock prices are a bet on future profits. So when investors bet on a future that never arrives, the price has nowhere to go but down. Markets are not moved by spreadsheets alone. They are moved by human beings, multiplied by millions, all reacting at the same moment. But if crashes are this common and this painful, why does the market always come back? The answer is where real wealth actually gets built. The answer is the S&P 500. It is not one company. It is a basket of 500 of the largest companies in America, from Apple and Microsoft to ExxonMobil. When people say the market went up today, this is the index they mean. And this boring basket has become one of the greatest wealth-building tools in human history. So let me introduce you to Sarah. Sarah is 25. She is not a trader. She does not watch financial news. She works a normal job. Every month, she puts $500 into an index fund that tracks the S&P 500. That is about $16 a day, roughly the cost of lunch. She does this for 30 years, and then she stops looking. Over those 30 years, Sarah puts in $180,000 of her own money. And this is where the math becomes shocking. If the market behaves anything like it has for the last century, Sarah ends up with close to $1 million. $180,000 in, somewhere near $1 million out. Sarah did not earn that difference. Time did. She never picked a winning stock. She never predicted a crash. She never beat Wall Street at anything. She simply refused to stop. And look at what she survived to get there. A dot-com collapse, a financial crisis, a pandemic, an inflation shock, and thousands of headlines telling her the sky was falling. The greatest investors in history were not the smartest people in the room. They simply stayed invested longer than everybody else. Stock prices are a bet on future profits. And over the long run, American companies have almost always found a way to keep growing those profits. But Sarah's money does not sit in a vacuum. Its value rises and falls on a force far bigger than any company she owns. And that force sits inside a quiet building in Washington, D.C. That building is home to the Federal Reserve, the institution that controls the cost of borrowing money in America. Here is why that matters to every stock you have ever heard of, and to every dollar Sarah owns. When the Federal Reserve keeps interest rates low, borrowing money becomes cheap. Companies expand faster. Investors chase higher returns in the stock market instead of parking cash in a savings account. Stock prices climb. But when the Federal Reserve raises rates to fight inflation, everything runs in reverse. Borrowing becomes expensive. Safe investments like bonds suddenly look attractive again. And future profits become worth less in today's dollars. Because remember, stock prices are a bet on future profits. And a future that is further away and less certain is worth less right now. Valuations fall. And here is the part almost nobody connects. Your mortgage rate, the one we mentioned in the very first minute, moves to the same rhythm. They are both children of the same parent, the cost of money itself. Which means the same decision that raises the payment on your house can also shrink the value of your retirement account. In the same week, from the same room, in the same building. That is why one sentence from the Federal Reserve chair can move trillions of dollars in minutes. The stock market and the Federal Reserve are tied together permanently, like two ends of the same rope. But interest rates and profits are only part of the story. There is a question most investors never think to ask. Who owns the 500 companies inside the S&P 500? The answer might surprise you. 3 names dominate stock ownership in America more than almost anyone realizes. Vanguard, BlackRock, State Street. Together, these 3 manage trillions of dollars, and they are often the largest shareholders in nearly every major American corporation. Most people hear that and assume Wall Street owns everything. The reality is completely different. These giants are not buying stocks with their own money. They are managing money on behalf of millions of ordinary Americans, through index funds, through exchange-traded funds known as ETFs, and through retirement accounts like the 401k. Which means that when Sarah sends in her $500 this month, she quietly becomes a part owner of 500 American companies at once. This is called passive investing, and it now dominates the entire stock market. And here is what nobody tells you. The biggest buyers of stocks today are not hedge funds or traders in expensive suits. They are teachers, nurses, truck drivers, and small business owners. automatically investing a slice of every paycheck without ever placing a single trade. More than half of all American households now own stock in some form. Every 2 weeks, without most people thinking about it, a wave of new money flows out of paychecks and into the stock market. Every one of those paychecks is another small vote that stock prices are a bet on future profits. So the stock market is no longer a playground for the wealthy. It is woven directly into the financial life of ordinary working Americans. Which raises the biggest question of all. If this machine touches this many people, how much of the American economy actually depends on it? Far more than most people ever stop to consider. When stock prices rise, people who own stocks feel wealthier, and that feeling changes their behavior. They spend more. On restaurants, on vacations, on homes. Economists call this the wealth effect, and it quietly pushes billions of dollars into the broader economy. A strong market year can add hundreds of billions of dollars in extra consumer spending. Spending that supports millions of everyday jobs, from restaurant servers to delivery drivers. When stock prices fall, the whole thing runs backwards. People pull back. Companies slow their hiring. Growth stalls. And here is the part that should stop you. You do not need to own a single share to feel any of this. If the market falls hard enough, the restaurant you work at gets quieter. Your company freezes hiring. The house you want gets harder to finance. Businesses use this market to raise money for new factories, new products, and new jobs. Retirement accounts, pension funds, and college savings plans all depend on it to keep promises already made. When the market performs well, millions of Americans retire on time. When it performs badly, millions of Americans work years longer than they planned. That is not an abstraction. That is somebody's 65th birthday, quietly moved to 69. Remember, stock prices are a bet on future profits, and those profits come from real jobs, real spending, and real economic growth. So the stock market is not a side activity happening far away from the real economy. It is one of the engines that powers it. And right now, that engine is being reshaped by a force more powerful than almost anything before it. Artificial intelligence. Companies like Nvidia and Microsoft are now among the most valuable businesses on Earth, built on the belief that artificial intelligence will reshape entire industries. Investors are doing exactly what they have always done, pricing the future before it arrives. Factories are testing robots that never sleep. Software is writing code that once took entire teams of engineers. Call centers, law firms, and hospitals are all being touched by the same wave. Some believe this will create the greatest economic boom in American history. Others are convinced it is a bubble that will burst the same way the dot-com bubble did. And here is what history quietly teaches us. Every generation believes that their moment in the market has changed things forever. The railroads believed it. Radio believed it. The internet believed it. And now artificial intelligence believes it. But every generation discovers the same thing. Technology changes. Companies change. Entire industries rise and fall. Human psychology never changes at all. Fear, greed, hope, panic. The exact same emotions that inflated the dot-com bubble are alive on trading floors right now, just wearing newer clothes. And that is exactly why understanding this machine matters more than it ever has. So let me leave you with this. The stock market is not a casino. It is a machine that turns innovation, productivity, and human ambition into a number you can watch on a screen. Your retirement depends on it. Your job is connected to it. Your mortgage moves with it. And Sarah, who never beat the market, never timed a crash, and never picked a single winning stock, ends up wealthier than almost everyone who tried to outsmart it. She only had to learn the rules. Stock prices are a bet on future profits. Now you know why. Because every stock chart you have ever seen is not really a chart of companies. It is a chart of human psychology, drawn one decision at a time. The stock market is not predicting tomorrow. It is pricing the future before tomorrow arrives. If this connected the dots for you, hit like and subscribe if you want to keep understanding the hidden economics behind money, investing, and the forces quietly shaping your financial future. I will see you in the next one.